You know, we've been hearing the whispers for a little while now, but it looks like it's official. Trade tensions between the US and China are really starting to heat up again. And look, this isn't just some headline for Wall Street. This is a story that could directly impact your bank account, your investments, and maybe even the cost of that next big project you have planned for your home. So I think the big question on everyone's mind is just that. Is the trade war back? Are we in for another round? Well, things are for sure escalating. So in this explainer, we're going to cut right through all the noise and figure out exactly what's going on and, more importantly, what it all means for you. Alright, here's how we're going to break it down. First, we'll look at this new standoff. Then, we're going to trace the economic ripple effects. From there, we'll get really specific about what this means for your money, and we'll wrap up with a clear financial action plan. Sound good? Let's dive in. Okay, so let's start at the beginning. Part 1. A new trade standoff. How did we get here? Again. Well, the heart of this new friction really comes down to one thing. Both the US and China have started slapping new fees on each other's ships when they dock at their ports. This isn't just a random fee, it's a direct tit-for-tat action, and that's a pretty big signal that trade tensions are seriously re-escalating. And you can really see that tit-for-tat nature right here. On the US side, we have the new port fees, plus new tariffs on specific goods like timber and furniture, and there's even a threat of much higher tariffs down the road. Now over on the right, you can see China's response. They didn't just match the port fees, no, they also hit some US-linked companies with sanctions and tightened their grip on rare earth exports. And you know, those are materials that are absolutely crucial for everything from our smartphones to our cars. This quote from China's Commerce Ministry, it really just says it all, doesn't it? It's a message that's both defiant and pragmatic. They're saying they're ready to fight to the end, but at the same time, they're signaling that the door is open for talks. So what this tells us is that while they are dead serious, a diplomatic solution isn't completely off the table just yet. Okay, so how does a standoff at a port thousands of miles away actually affect you? Well, that brings us right to our second section, the economic ripple effect. We're going to follow the money from the port all the way to your pocket. You know, it might seem really distant, but a fee on a ship in Shanghai can have a direct impact on your budget here at home. See, it all starts with those new port fees. That makes shipping more expensive, and those higher costs, they get passed down the entire supply chain, from the shipping company to the manufacturer to the importer and then to the retailer. And of course, who's at the very end of that chain? Yep, we are, the consumer. The final price tag on those goods just go up. So in a situation like this, who wins and who loses? Well, it's pretty clear that shipping and logistics companies are going to face higher costs and disruptions. Retailers and importers who really rely on Chinese goods, they're going to feel a serious squeeze on their profit margins. And of course, US consumers are likely to see higher prices. But there is one potential winner here. Some US manufacturers might actually get a mild competitive advantage simply because the imported goods they compete with just got more expensive. This brings us to what I think is the most important part of our whole discussion. Section 3. What it means for you. Let's translate these big economic ideas into real-world dollars and cents. Just take a look at this number, $3 million. According to freight analysts, that's the potential new fee a single cargo ship could face. Just one ship. Think about that. That is a massive new cost that's been injected into the system practically overnight. And you can be sure that a $3 million fee doesn't just get absorbed by some giant faceless corporation. No way. It gets broken down and baked into the price of every single thing on that ship. It trickles right down to the price tag on that new sofa you've been eyeing, or the cost of the materials for that kitchen remodel you've been planning. So here are the three main ways your wallet is probably going to feel this. First, you can expect higher costs for home goods, especially furniture and cabinets, since those were directly targeted by the new tariffs. Second, this kind of trade friction can add fuel to inflation, which might make the Federal Reserve think twice about cutting interest rates, and that means mortgages and other loans could stay more expensive for longer. And third, well, markets absolutely hate uncertainty, so you should probably expect to see a lot more ups and downs in your 401k or other investment accounts. Alright, so we've laid out the problem, we understand the challenge, now let's talk about solutions. In our final section, we're going to walk through your financial action plan with some smart, steady steps you can take to protect your wealth. So, here it is, a clear, totally manageable 3-step plan to help you navigate all of this. And remember, this is not about panic. This is about preparation and smart positioning. Okay, step 1 is all about playing good defense. If the cost of things is going up, that means your dollars just don't stretch as far as they used to. The single best way to protect your purchasing power is to make sure your cash savings are strong. Right now is the perfect time to build up or just top off your emergency fund to create that buffer against rising prices. Step 2 is all about your long-term strategy. When markets get choppy like this, the absolute worst thing you can do is react emotionally. That means avoiding the temptation to panic sell, making sure your portfolio is well diversified, and really focusing on quality long-term investments instead of trying to time the market. You've got to stay the course. And step 3 is about being strategically informed. You're going to want to keep a close eye on your calendar, specifically for late October. There's an expected summit between the US and Chinese presidents, and that is a huge potential pivot point. A good outcome could calm the markets down, a negative one could make things even worse. Just knowing what's on the horizon is so important. All this talk about uncertainty, especially with big events like that summit coming up, it really hammers home the need for investment resilience, right? So it's totally natural to ask, what does a resilient portfolio actually look like in practice? Now, of course, this is just a sample strategy. It's not personal financial advice, but it illustrates the principle perfectly. A healthy mix of broad index funds to get that general market exposure, some quality domestic stocks, a helping of bonds for stability, and a solid cash position. All of that helps make sure you aren't overexposed to any single part of the market. It really is all about balance, especially in times like these. And that brings us to our final and most crucial point. Geopolitical events like this will always create turbulence in the markets. It's just a fact. But trying to react to every single headline is a losing game. The real key to financial well-being through any storm is having a smart, steady plan and having the discipline to stick with it. Because at the end of the day, smart planning will always beat panic.